Hello. This statement looks at preparing a direct statement of cash flows. Accountants have two options. We can either prepare cash flows using the indirect statement of cash flows or the direct statement of cash flows. The indirect statement of cash flows has us first break the cash flows into three streams. Cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. In this regard, there's no difference between the direct statement or the indirect statement. However, from here, the statements are different. The cash flows from financing activities and the cash flows from investing activities are really handled the same way, whether you do a direct or an indirect statement. But what makes the statements different is how you treat the cash flows from operating activities. In the statement we're going to look at, direct statement of cash flows, we directly consider how much cash flowed in from each activity, how much cash flowed out from each activity. In the indirect statement though, not the one we're going to do at this minute, we often start with net income and reconcile back to net cash flow from operating activities. That statement, you might say, is easier to produce because we have more resources that one could use to produce it. For example, we have an income statement and we have balance sheet accounts. So why do the direct statement of cash flows? Well, this is the statement that FASB suggests accountants use. First, I want to give you a few facts that will apply for the problem, and then we'll go ahead and look at what's required. So, in just a minute, we'll look at a balance sheet and an income statement for Bill's Music Store. Now, we're going to consider a couple other facts that are given to us in the problem. First, equipment used in the business of $420,000 was sold during the year. Just write that down or keep it tucked in the back of your mind because we're going to do something with it in a little while. Also, $808 in cash dividends were paid to stockholders of record during the year. The requirement for this problem is using the above facts and the balance sheet and the income statement, which we're going to look at next, create a direct statement of cash flows for Bill's Music Store for December 31st, 2014. Here's a balance sheet for Bill's Music Store. As we know, balance sheets are good as of the last day of the year. Bill's had cash, had accounts receivable, had inventory, had equipment, and there was some accumulated depreciation on the equipment to net against the equipment. If you haven't already done so, jot this down in your notes, or otherwise you'll need to refer back and forth on the video to what comes next. So we have total assets for 2014 of $4,316, and for 2013, $3,285. Liabilities and equity have to equal assets, as we know from the beginning of Principles of Accounting. So our ending balance at December 31st, 2014 is $4,316. Our ending balance for 2013, $3,285. Here's our income statement. It's simple, designed to allow us to do a short video and see how to use it to do the direct statement of cash flows. So here, Bill's Music Store income statement is for the year ended December 31st, 2014. There were sales of $3,123. You see two items of expense, cost of goods sold and depreciation. They created total expenses of $1,392, and the net income totaled out to $1,731. Given all the facts you've seen, the balance sheet, the income statement, and the facts, produce a direct statement of cash flows. That's our requirement. Okay, to fit everything on the page, I've cut off some of the heading information at the top, but hopefully you saw it when I was first putting it up here. It's easy enough to remember. Bill's Music Store, direct statement of cash flows, year ended December 31st, 2014. So the first thing we need to do is find those cash flows from operating activities. So you can see here that I've determined that we had a cash inflow from customers of $2,873. Well, where did that come from? Notice it came from sales on the income statement of $3,123. See the number here? However, those sales had to be adjusted for the change in accounts payable. I'm sorry, the change in accounts receivable. Those words sound a lot alike, as you know. So we had a change from 280 last year to 530 this year. And remember that accounts receivable represents sales that haven't been paid in cash yet. So we're going to subtract the $250 increase. When we do that, we take the 3123 sales but subtract the 250 increase, we come up to 2,873 cash inflow during the year. Well, there was also a cash outflow. For starters, we'll use our cost of goods sold number. That number is 980. However, that may or may not be cash purchases. First thing we have to consider is that inventory could have been used to satisfy some of the cost of goods sold that we sold this year. Inventory had changed by $285. $680 this year, $395 last year. And accounts payable was used to pay for the inventory. And we're making an overtly simplistic assumption here that the only purpose for accounts payable is to pay down purchases of equipment. So accounts payable rose this year from $630 to $780. One way to look at this would be cash was used to pay off the $630, but at the end of the year, there's $780 for which cash hasn't been paid yet. When you put these all together then, the $980 cost of goods sold, the change in inventory, $285, added to the $980, and then you subtract the increase in accounts payable, we see that there were cash outflows to suppliers of $1,115. So when we net $2,873 $873 and $1,115, we arrive at net cash flows from operating activities of $1,758. The next thing we do is consider the cash flows from investing activities. So there was a change in equipment this year. Notice equipment last year was $2,690. Equipment this year, $2,950. However, we were also told at the beginning of the problem in the facts that equipment of $420 was sold this year. So if we now have $260 more in equipment than we had last year, we must have repurchased $420 worth of new equipment plus $260 additionally. And so 420 plus 260 is 680. Well, remember that the cash flows from operating activities were net inflows. Here, the cash flows from investing activities are net outflows. There's no need to write the caption, net cash flows from investing activities, if there's only one thing. So we can net these two numbers. 1758 minus 680 is 1078. Net cash inflow so far. Now here is the second page, the completion of the direct statement of cash flows. So here we bring our number over from the previous page, 1078. We go back to those original facts and we find that $808 were paid out to shareholders of record as cash dividends. So we subtract the 808 from the 1078. We arrive at a net increase in cash of $270. And now we have to check and see if this is right. Does our cash balance January 1st agree to the balance sheet as of January 1st? And it does, because here's the December 31st, 2013 or January 1st, 2014 cash number, which is 220. And notice the 2014 number is 490. That serves as kind of a check that if either of these numbers didn't match up, the beginning cash or the ending cash, our cash flow statement would be wrong. As it is, the cash flow statement is great. Give me a call if you have any questions. This is a simplistic version of the problem, but again, probably very similar to something you might see on the final exam, and you will probably see simpler versions of this, such as just computing the cash inflows from customers or cash outflows to suppliers in the multiple choice section of any test. Take care. Let me know if you have questions.